on the 25th of November 2017. This week in economics from WBRN Radio in Boston and on the Bostonred Network. Under our marker here called Numbers Man. Nonetheless, we'll move on with it. Some anecdotal evidence available now out for the Friday, the Black Friday / Thanksgiving holiday season, what they have seen so far. A sharp rise in, this is from Reuters incidentally, a sharp rise in online sales brightened the overall outlook for those traditional retailers that have expanded beyond brick-and-mortar outlets, sending their shares higher in day after Thanksgiving trading. There was little evidence of the shopping frenzy customary of delirious shopping frenzy of Black Friday from past years, even as stores appeared to be getting creative with gimmicks besides heavy discounts to draw in customers. No actual data from brick and mortars was immediately available. The online sales totaled at least $3.54 billion. That was by 8 p.m. Eastern Standard Time. On Saturday, up 15.6% from a year ago. That's according to Adobe is now. And you remember Adobe? They have flash and everything. Adobe Analytics, which measures transactions at the largest 100 U.S. web retailers. On Thanksgiving Day, U.S. shoppers spent more than $2.87 billion online. Adobe projects internet sales to reach a record of $5 billion by the end of the night, with online sales forecasts to rake in an additional $6.6 million on Cyber Monday, another big day here. Good news for consumers. Some chains struggle to keep up with brief online outages. Lowe's, H&M, and The Gap. Macy Incorporated, customers in several states, including Texas, Arizona, and Illinois, took to social media to complain about the retailer's credit card processing system. The company acknowledged that processing was taking longer than usual in its stores. The hiccups Macy's shares down 0.6% lower in extended trading. They ended the season, the regular season, up at 2.2%, boosted by comments from Jeff Gannett, who told CNBC that Macy's was better off this year than last. It doesn't mean very much. Macy's and JCPenney did a better job ordering and controlling inventory this time around. That's according to Bart Flickeringer, the managing director of Strategic Resource Group, a consultancy, one of many, many consultancies out there. Fair weather across much of the nation also was a factor. The National Retail Federation president, Mr. Shaw, had that to say. Some shoppers were by promises of a spectacular, while others felt the pull of nostalgia. Enticed. Let's see what else. A major retailer generated trade higher on Wall Street. JCPenney climbed 0.6%. Walmart stores edged upward. Amazon online closed up 2.6%. Target did not fare as well, with analysts noting that it closed stores for several hours overnight, while many rivals kept their doors open. So they fell 2.8% at the Target stores. The period between Thanksgiving and Christmas make or break a retailer, accounting for as much as 40% of the take. Chains of Walmart, Macy's, JCPenney opened stores on Thanksgiving. Even most were offering extended deals online. Some started offering in-store deals earlier this week. Macy's said some 16,000 shoppers were lined up outside its flagship Herald Square store. Nonetheless, a false report of gunfire prompted shoppers to flee Westland Mall in Florida, Hialeah, and it reopened hours later. The growing online shopping trend led by Amazon has found the it forced the toy store, which is no more Toys R Us, and apparel retailer True Religion and Limited in some others, and Payless Source to file bankruptcy this year. Toys R Us, as far as I know, is no more. Some traditional retailers earned the bulk of their revenue from in-store buys. Shoppers in brick-and-mortar stores can also be easier tempted with impulse shopping. Yeah and no. Macy's workers there said it was less busy on Friday because the store had opened and was packed on Thursday. Well, that's one of that was in Pomona, New Jersey. So in other words, if you're open on, this is one of the things in the seesaw economy, our seesaw model sees this. If shoppers go out, for instance, on Thursday, which was extended hours on Thanksgiving, there is not the liquidity available to go into a Black Friday. So you settle for one or the other. I think this is... well, anyway, shares of Amazon and Macy's, Kohl's Corporation, and other retailers rose on a Friday. Make sure we're not going over the same territory. I think we are. So there are two articles here from Reuters, very similar in nature about the holidays, and we had queued up two distinctive ones, and let's see, there's one more also that is on the holiday. Online sales. This is the one we wanted. Wait a minute. This is not the one we wanted. I want to talk about Chanel. Maybe one day says this is France, excuse me. Chanel has no immediate plans for online sales of its outfits and handbags. Well, I suppose not. They don't need to. There's Chanel. But there are many handbags available online if you so desire to get a handbag, I suppose. You can definitely find one there. And there was one particular article we had looked at here. This is the one, and this may, anyway, U.S. shoppers browse at stores. That's been a continual pattern, and yet they buy online. In other words, they see what the product is and go immediately to online. Now let's go to our package here. We're talking about unemployment, why Trump should be more weary of below 4% unemployment than he seems to be. This is from the Washington Post. And there's a series of articles here. This was on the 20th of November, citing the president with Stuart Barney, his longtime presenter on CNN, in which he cited Goldman Sachs numbers. We'll get to that in a minute. The economy is fairly strong already, and we have big companies like Goldman Sachs predicting the unemployment rate will drop all the way down to 3.7 next year. We've got momentum, Stuart Barney said. And yes, they do. And one of the problems here, how low is unemployment? Too much of a good thing. That's Nicole Smith, chief economist at Georgetown University. We'll get to them in just a minute. 4% is not exactly a number that economists are necessarily happy with. Smith says it has been here. It was there before in the late 60s. We've seen historically at other times when the unemployment rate has fallen below 4%. But when it did, it was at a time the U.S. was a much smaller economy. the Federal Reserve data, we can visualize that in the 50s during the Korean War, before my time, and later in the 60s, the rate were low, and no doubt about that. Arthur Occam used to talk about that. We used to cite full employment as about 2.3%. When I was at university, I believe that's what we were doing. That was in the early 70s, late 60s. Anyway, what we find is that low unemployment rates often associated with a boom phase just before recession. Smith said that's part of what they euphemistically refer to as the business cycle. It's almost a precursor for recessions or a precursor for another slumping economy. That can happen, and basically what you look at there, we have more controls, incidentally, on the economy today than we did in the 60s, but also much more robust and internationalized, global, we use the word global economy than was seen in the 60s. So really, you can't compare the two. Let's move on here. To Goldman sees Fed raising rates 4 times in 2018. Probably will be necessary there. 4 rate hikes, more than Wall Street had been anticipating in 2018. That's a Reuters poll. The central bank has raised rates twice this year. Yeah, but basically 25 basis points. In benchmark lending rates, is current rate of 1% to 1.25 that end of the year here if they raise it again. So thus, let's get this down first. They have raised their domestic GDP growth forecast for 2018 to 2.5. The lower the employment rate is 3.7, ending in 2018 to 3.5 by the near end. They call it near end of 2019, and you can see basically here you are in the threes. You have 4 now. The rate fell to a 17-year low at 4.1% in October and 4.2%. Not very much there in terms of numbers. You have those numbers. Let's go to the Goldman Sachs numbers. For the first time since 2010, the world economy is outperforming most predictions, a trend that Goldman Sachs research economist Hardis and Jerry Steinem see not only continuing but amplified by 2017. Somewhere we have it here. The global economy to 4% GDP growth next year. Now, a forecast notably above the consensus expectation, supported by still easy financial conditions and fiscal policy. Stubbornly low core inflation. That can be somewhat of a problem if you have low inflation, but also you can get into deflation, and that is something economists look at very, very closely. Let me just move along here. Wait a minute, just a second here. We probably have it, but I'm not certain where we have it at this point in time. We need to open up the report. We had it sitting on the desktop here, as good as it gets. This is from Goldman Sachs and Company. For the first time since 2010, we talked about that. Global GDP forecast for 2018 at 4%, up from 3.7 in 2017. Above a consensus, on the supply side, we've seen tentative signs of a rebound in productivity growth from a dismal post-crisis trend. And I'll put this on here. The question is no longer whether output will overshoot a potential, but by how much? By contrast, Southern Europe needs several more years of strong growth to return to full employment. If the output gap has largely closed, Why is the core inflation so low? Our analysis suggests that a good part of the answer lies in a sizable and relatively long-lasting drag from the earlier weakness in exports and commodity prices, which have offset the relatively small, though statistically higher, significant impact of diminishing slack so far. We talked a lot about slack last year in the economy. Over the next year, these pass-through effects are likely to diminish, and we expect a gradual increase in core inflation abide to levels that are still below the central bank's target, 2%. If inflation does move up, the strength in activity will soon feel like too much of a good thing for some federal central banks, which needs to slow growth to trend to a rate to prevent a bigger overheating. Now, these are tools that didn't have in the 50s and 60s. Bigger recessions risks down the road. So our Fed call is considerably more hawkish than market pricing. We're also above the market in a smaller G10 economies such as Sweden, Austria, and etc. The European Central Bank targets here. I'm going through this rather quickly here. For now, faster Fed tightening is unlikely to weigh significantly on growth, where divergent monetary policies typically have limited net financial spillovers, while the impact of emerging economies could be more significant. We think that the recent structural adjustments have left the emerging economies, more resilient than in the past. We'll get to Zimbabwe here in a minute and look at where they are on the new regime. Global growth has outperformed the consensus expectations meaningfully in 2017. Real GNP grew by 3.7 this year, significantly above the end of 2016, the consensus forecast of 3.3 gain. Now, that's 0.4% there. G7 growth this year has beaten the Bloomberg survey of economic forecasters for the first time since 2010. Not a good sign there, but anyway. Even on high-frequency basis, the news remains very positive, and they are pointing to some things here. The global current activity index stood at 5% in October, up from 3.3% a year ago. So in other words, this has been a global situation here. And let's see, strength in growth is based on is broad-based across countries. They had all major emerging countries here, 3 months moving average across the Eurozone, Sweden around, anyway. A number of emerging economies have recently outperformed their post-crisis basis, including China's a little bit different. Here, let's see what else we got. Well, deal so much there. This is the graphs. You can see these when you read it. Tax reform and debate has moved quickly in recent weeks. This is in the U.S. We believe the probability of an agreement by early 2018, most likely in January, has risen to around 80%. The outlook in the Senate is not yet clear, but the signs in the chamber are moving positive than they have been several months. Well, yes and no on that. There's a possibility they could do something by the Santa Claus holiday. We projected real growth of 4% in 2018. And we at this mic a little bit leery of that, but remember now, if you're coming from growth of 3.7%, you're talking 0.3%, not as bad. The strength is quite broad-based across advanced economies. The The U.S., again, back to 2.5 in 2018, the Eurozone at 2.2, and Japan at just 1.6. The U.K. is the main underperformer, and they will underperform more due to Brexit. It's not good for business. By contrast, China appears to be slowing modestly there, down from a peak of 7.5% to in June to 6%. That's not bad for China because things were overheating a bit there. Therefore, we expect China growth to slow gradually from 2.8 to 6.8. I'm sorry, and 6.1 in 2019. And they have the numbers here. I won't go over these. You can read this particular thing from the Goldman Sachs people. Some of their projections here. And remember, these are projections. Exhibit the Phillips curve is alive but a weak. We did talk a little bit about the Phillips curve. Let's see if we can. Wedge Group confirms that the Phillips curve's relationship has not broken down. At least we adjusted for a significant slowdown in productivity growth. Our analysis suggests that the labor market slack productivity and lags headwind inflation explains the ups and downs of wage growth pretty well across the G10. We found that labor market slack plays a key role in slowing wage growth down after the financial crisis, but no longer acting as a major break for aggregate in G10. Instead, the model says that weak trend productivity growth as keeping wages down below the pre-crisis norm across all economies in our sample. And this is Goldman Sachs' we. Our results, therefore, point to building a price pressure in a number of advanced economies, including the U.S., UK, Sweden, and the commodity price exporting countries. We've seen petroleum go up quite a bit. We're wondering where that's going to go in terms of we are looking here. Monetary policy divergence. Our conclusion for monetary policy still emphasizes the divergence of conditions across the G10. Shows a simple central bank scorecard summarizing the central banks. We see that a number of central banks are already faced with labor market overheating, and they have some of those here. Monetary policy forecasts are consistent with the assessment, as they call it. The Fed is considerably more hawkish than market pricing, and with a hike in December, we agree with them. They have an 85% probability. The baseline forecast of 3.25 to 3.5 by late 2019. Now that's roughly 2 years away. By contrast, short-term interest rates, futures for late 19 imply a jump of 2%, even after the recent bond sell-off. So, yeah, you could have 3.25 to 3% interest rates there. That's one way of cooling things down. Monetary policy is also like to diverge across major emerging economies. We anticipate broadly stable monetary policy in China. You're seeing that now through a single easing, although required to maintain growth at 6.5%. China has had a lot of easing there, and their real estate market was overheating. The biggest risks are political, no doubt about that. Spillover effects from tighter Fed policy should be manageable. Our research shows that monetary policy shocks have a little systematic effect on financial conditions. One of the reasons for this is that the market, stock markets play an increasing role in the economy, and in the U.S., the U.K., and many of the capitalist economies, you have the consumer at about 70% of the economy. So that monetary policy has a little effect there, unless consumers are buying homes perhaps on their credit cards. Now that interest could go up. Emerging markets, however, could be more at risk from tight Fed policy. Emerging economies keep their exchange rates at least partially fixed, which means that they have to import tight money when the Fed hikes. This is borne out in data. Now, we won't get into the exhibits that they have there. We will go to Zimbabwe as an emerging economy. Indeed, emerging FCIs have tightened somewhat in recent years, no doubt about that. The biggest risk to global outlook are likely potential, like NAFTA. Well, NAFTA is an interesting situation there between the U.S. and Mexico, more in Canada. They're pretty much ironing out some things there. Moreover, escalating tension in Korea, on that Korean peninsula, that could be much more of a problem than other types of things. Long-term condition growth near recent trends that would likely push a number of advanced economies more significantly beyond their capacity to produce, risking recessions. Now, this is an ongoing problem and something we have to guard against, no doubt about it. And a natural, I won't spend a lot of time on the natural rate. This is from The Economist. The natural rate of unemployment. Policymakers have spent a half century in search of the natural rate of unemployment. Why does unemployment exist? There is a central question in macroeconomics. This is it. There are a few bigger wastes than the loss to idleness of hours, days, and years by people who would rather be working. Unemployment can ruin lives, sink budgets, topple governments, yet policymakers do not wage all-out war on joblessness. Most, like the Federal Reserve in the U.S., the central bank, targets what is known as unemployment's natural rate, at which inflation is stable. The importance of this concept is hard to overstate. The Fed's argument for real interest rates rise, for example, hinges on stopping unemployment from falling too far beyond the natural rate. Yet the natural rate is, in many respects, an article of faith. Well, you can't do very much on that. There are several reasons why unemployment can't simply be eradicated fully. It takes time for people to move from one job to another. Not as much today. This is said to cause fractional unemployment if people cannot find jobs because they have outdated skills. Think hand weavers after the invention of the loom. They might become structurally unemployed. You're going to see a lot of structural unemployment as we move forward with automized cars. John Maynard Keynes, the great British economist, they call him that, Keynesianism, for those. Anyways, the first step towards natural rate hypothesis when he focused minds on insolvency, unemployment in his book, The Great Theory, published in 1936. That was in the Depression, the aftermath of the Depression. Keynes noted that many people could not find jobs at the going wage, even if they had comparable skills to those in work. Classic economics blamed artificial high wages, perhaps caused by trade unions. But Keynes pointed to the lackluster economy-wide spending. Even if wages fall, he reasoned workers would have less to spend, making the demand deficiency worse. The answer, he thought, was for government to manage arrogant demand in order to keep employment full. Keynes was not the father of all now thought of as Keynesianism. Inflation, for instance, barely entered into his analysis of unemployment. By the late 1960s, Keynesianism had become associated with the idea of when managing arrogant demand. Policymakers are not just choosing a rate of unemployment, they are simultaneously choosing how fast prices rise. The relationship between inflation and unemployment was first studied by Irving Fisher in 1926. But the Phillips curve, which we just talked about, sometimes we'd like to reiterate these, as it became known, owes to its name, 1958, Dr. William Phillips, of London School of Economics. In his study, Phillips traced a relationship between unemployment, wage growth in Britain over the course of almost a century, 100 years, and found that from 1861 to 1957, the relationship had been pretty stable. The lower the unemployment rate, the faster wages rose. This was remarkable given the change over the period in workers' rights. In 1861, most workers could not vote. By 1957, they could vote. Let me just get this is kind of important to bring this up. Paul Samuelson and Robert Solow, two economic luminaries, subsequently investigated the relationship in America and reported that there was no such stability there. Phillips' curve shifted around, but in any given era, Samuelson and Solow wrote wage growth do tend to rise when the labor market is tight, and the tighter the faster. We used to use that book, was used in my university, Paul Samuelson's favorite book there. Anyway, they described the relationship as a menu, encouraging the idea that the job of the Keynesian policymaker was to pick a point on the curve that might align with their preference. How low unemployment could fall, in other words, depended on what level of inflation was tolerated. For rising wages would surely end up lifting prices too. It's unclear whether the policymakers actually thought of the relationship between inflation and unemployment as a menu, but the idea was prominent enough by the late 60s to attract withering criticism in two detractors, Edwin Phillips and the late Milton Friedman. Phillips began writing groundbreaking models of the labor market in 1966. A year later, Friedman gave what became the conical criticism of the old way of thinking in addressing the American Economics Association, in that he argued, far from being a menu of options for policymakers to pick from one rate of unemployment and a natural rate would evidently prevail. Friedman reasoned that the central bank prints money in an attempt to push unemployment lower than the natural rate. A large supply of money would lead to more spending. Firms would respond to increased demand for their products by expanding production and raising prices, say, by 5%. The inflation would catch workers by surprise, and labor for a while would be artificially cheap, which it is now. The next pay was negotiated. Next time pay was negotiated, however, workers would demand a 5% raise to restore the standard of living. Neither firm nor workers had gained or lost negotiating power, but the worker could be fooled only for so long. They would come to expect 5% inflation, which would insist upon conversely higher wages in advance. The implication for the central bank is to keep unemployment below the natural rate. Friedman reasoned that Keynes was wrong to pin a low rate of unemployment to a given high rate of inflation. To sustain unemployment even a little below the natural rate, inflation would need to accelerate year in and year out. Phillips' natural rate became known as a non-accelerating inflation rate of unemployment. No society could tolerate endless rise or falling in inflation. Phillips had observed a correlation in the data, but he was not the one that policymakers could exhibit in the long run. there's always temporary trade-offs between inflation and unemployment, Phillips said. Freeman, sorry about this. There's no permanent trade-off. 50 years on, that remains the premise on which the rich world's central banks operate. I'm going to finish this up. It's a very long article. I think we're going to pinch this. Let me just go down and get this finished. All jobs, inflation has behaved strangely over the past decade. The recession that followed the financial crisis of 2007, 2008 sent American unemployment soaring to 10%, in many places well above that. Inflation below 1%, nothing like the fall that the models predicted, because of the way economists can estimate the natural rate by watching how inflation and unemployment move in a reality. They assume that the natural rate had risen, by Robert Gordon of Northwestern University, putting it at 6.5, yet the labor market was tightened. Unemployment was 4.3 in July. Such volatility, just about to the end of this. Such volatility in the estimate of the natural rate limits its usefulness to policymakers. Some argue that the wrong data are being used because unemployment rates exclude those who have stopped looking. I would say that the short-term Phillips curve has floundered as inflation expectations have become even more firmly anchored. The question is, how long will they remain? So as long as low unemployment fails to generate enough inflation, the central bank will face a pressure to keep applying a stimulus. Well, the stimulus has kind of disappeared for now. Their hard-won credibility and ended back in 1980. I remember Paul Volcker fighting. We had 18-19% inflation at that time. The most recent experiment has led some to doubt the very existence of the natural rate of unemployment. That has been a big question. But to reject the natural rate entirely, you would need to believe one of two things. Either central banks cannot influence the rate of unemployment even in the short term, or they can peg unemployment as low as they like, even zero. That's been talked about. Negative rates as far as inflation is concerned. Neither claim is credible. Natural rate of unemployment surely exists. That's according to economists. Whether it is knowledgeable is another issue, and they did a correction describing natural expectation hypothesis. The article generally states that whenever the public suspects that the central bank would try to push employment below the natural rate, inflation would rise immediately. This should have said employment, or unemployment, It has been corrected. Sorry about that. So that is the natural rate. Where does it go? Well, when you go below the target rate, you can get yourself into some trouble there, no doubt about that. Let's go to the BBC now. China cuts import tariffs on almost 200 consumer goods. The finance minister said tariffs will drop from an average of 17.3% to 7.7% on products including pharmaceuticals, food, health supplements, and clothing. Very important there in a very large economy. China's move was welcomed by his Scottish whiskey producers, which will see their tariffs fall from 10% to 5%. Well, they'll be able to get more Scotch in there. Let me just go quickly to Zimbabwe. I'd almost forgotten about it. The stock market there, we'll just cover just a little bit here. Trading at the Zimbabwe Stock Exchange was characteristically characterized by limiting trade volumes, including the mainstream industry index at 5.07 there. to 329.63. Anyway, Barclays was the only counter that it recovered to its regular 6.36 and ended at 5.2%. So in other words, it has been lower. This is incidentally from the Zimbabwe Broadcast Corporation. The losses there were 18.87 there, and some mutual funds won't go into where they were, but that is some of the story there. The market, their stock exchange Zimbabwe has been very low the last week because of turmoil that has appeared there. And let's see if we can... Industry ready to work with new government, more business friendly type environment there. And what else? Construction industry. There's a general strike incidentally in Zimbabwe's construction industry. That is on the 21st. We're up to the 22nd. And that was the one we just had. Anyway, that will do it there. A little general idea of what is going on there. Let's see if we get the gross domestic product here. Let's see, gross GDP current prices. I think it's about 2.6 if I get that right. Last time I looked at it here. And let's see, little population statistics. I'll get them up here. In 2012, 12.8 million people there. And the inflation rate in Zimbabwe, according to their official figures, let's see here, March. In August, a negative 0.13 in August of this year. So basically where it is in Zimbabwe, where they are moving along here, trade statistics. Oops. Yeah, Well, we only have those. Well, let's get the unemployment rate, and then we'll go to the BBC. 2014. Well, at 11.3 is what they have here. Anyway, we'll let that go and go on to the BBC. And we did China, so now we'll fly along here. Let's do the markets. Well, we can do the markets. These are on Friday, unless otherwise noted. The BBC Global 30 at 6. Let's see here. At 6.91. The FTSE All Share was down 5.23. In Amsterdam, they were at not a 0.72. In Frankfurt, the DAC at 51.29 on Friday. In France, they were at 10.52. In Brussels at 7.27. In Madrid at 20.70 on Friday. In Zurich at 10.4. In Moscow on Friday at 12.61. And in Johannesburg on Friday, 294.82 in the negative there. In Bombay, 91.16. In Karachi, negative 17.80. In Lahore, negative 46.11. In Colombo, negative 42.43. And in Tehran on Wednesday, 564.50 in the positive. In Sydney on Friday, negative 4.40. The Nikkei at 27.70. It was in the positive. Hang Seng at 158.38. Wait a minute, hold it. That's 108.38. You just get my screen. I'm getting a little glare. Anyway, the Hang Seng in Hong Kong at 158.38. In Shanghai on Friday, they were at 1.90. In New York, 31.81. The Nasdaq at 21.80. The Merc, that's the commodities market out in the Midwest city of Chicago, at 5.14. And in San Pablo, 1,046.17 on a Monday. And finally in Mexico, a negative, these are negative incidentally, a negative 648.42 in Mexico. And to make sure that one that between green and red, they've got me going on these figures here. Had to pull out the old glasses. Yeah, okay, in Shanghai, yeah, we got that right, 1.90. Okay, on to the commodities. Pull out the old glasses here. Anyway, Brent crude futures on Friday up was 18 cents at $63.73. The spot was up, let's see, 23 cents at $58.59. West Texas crude was up 26 cents at $58.81. Gold on the Forex was down $1 at $1,286.15. Dubai gold was up $3 at $1,293. Period. Silver was up 5 cents at $17.05. Your next life futures. Cocoa was $10. Robusta coffee futures, holy moly, was up $116. White sugar futures was down to $9.66. And then we're getting any relief here. Winter feeding wheat, I guess they call it, futures up $1.65. And the Bloomberg Commodity Index was out on Wednesday at 85.59. Thus, this will do it for us. Let me just make sure at the BBC we didn't overlook anyone that should not be overlooked. It's an interesting way of saying it. But nonetheless, we got the shopping season out of the way, at least anecdotal information. Next week we'll have more complete information. Incidentally, Amazon workers in Europe are on strike. So that evidently put kibosh on retail sales across Europe, at least as far as Amazon is concerned, since the workers were on strike there. And they've stopped some illegal overtime at some of the iPhone suppliers. So that has sort of changed things a bit. And in another item here, Facebook is coming out with a toolkit so you can look at fake news on their sites. So we'll see where this all boils down to. Evidently a good week for consumers. We'll look at the prices. For those in business, next week a productive one, which is the retailers are hoping to do that, with the exception, I guess, of Target Corp. And Walmart didn't hire any extra workers, but they're working their workers as let's say as boldly as possible. Period. So we will see that moving there. And in Zimbabwe, the long-serving president, Robert Mugabe, is retired, have been forced into retirement after 37 years. And a new president is there, Mr. Emerson Mugabe is now the president. He was the vice president. He supposedly is coming with a business-friendly government and perhaps will invite the IMF and World Bank back into their economy. The only question there is they do have a large foreign debt. How will that be taken care of? There will obviously be some debt forgiveness, but how much debt forgiveness? 10-20% perhaps. But they still will be saddled with that, and any additional monies that they receive, they will be on the regiment of these organizations. And that has happened before. The IMF has admitted many nations that they forced into 19 years ago into austerity. It did not work out at all. So my advice to the Zimbabwean government, to be very, very careful of what agreements they get into. So we'll see on that one. That is an emerging market. Their population there, 80%, more than 80%, are below the age of 30 years old. Only 5% is 65 and older. So that, my arithmetic is correct here, leaves about 15% between 30 and 65, in counting in the other direction. So in other words, a lot of skilled, educated Zimbabweans are now in South Africa. So some of those people will, as they say, trickle back home as job opportunities avail themselves. But in an emerging nation, it is very, very hard because of sanctions against Zimbabwe. They will probably ease those sanctions now, and they are pegged more or less to the dollar these days. And so they'll have to look, and again, we go to some other countries, such as Russian Federation. They are no doubt benefiting from high petrol prices. And there's this big, perhaps, battle coming between the Saudis, OPEC, etc., and they have been freezing their prices to sell more petroleum product, but also the fracking and what have you in the U.S. has pushed the U.S. as number one producer of petroleum product or oil and in the gas. So in other words, these situations have to be corrected. They are high at this point in time, but when will OPEC, as they say, let the spigot start spicking, and then you'll get into oil at a cheaper rate. Gas prices in the U.S. have been steadily climbing towards the magic $3 point, and again, there is a trade-off of how much liquidity consumers have, and we'll assume that over the holiday season, people will buy what they need to buy, and then you will see January and probably the latter part of December, not a lot of retail activity will be occurring. Of course, you'll see some of the larger retailers such as Sears, JCPenney, closing some of the stores that they now have open will close early next year, so making more people redundant that are in the retail sector. So we'll see some of that also happening out there. And because of mergers in the information technology sector, there will be some job losses at some of the largest, such as GE's development people, some of their units laying off people. Most of these layoffs are not that large, but they will impact things. And also your seasonal workers, as particularly retail workers, etc., will start to disappear. Have a good weekend, everyone. We'll see you next week.